Imagine checking your mail on like a perfectly normal Tuesday.
Right, just grabbing the usual junk mail.
Yeah, exactly. And you open this envelope from your condo association and you're expecting a routine notice, maybe an update about pool maintenance or, I don't know, a slight bump in next year's budget.
Sure, maybe an extra $50 a month.
Right. But instead, you pull out a bill, a mandatory special assessment, and it isn't for a few $100s. It's not even for a few thousand.
Oh, man.
Yeah. It's a demand for $100,000, due in installments starting next month. Oh, and right below that, a nice little notice that your regular monthly dues have just doubled.
I mean, that sounds like a catastrophic billing error or some kind of extreme fraud case, right?
It sounds completely impossible, but if you own a condo in Florida right now, or, if you're looking to buy one, this is not a hypothetical scenario at all.
No, it's happening all over.
It is happening all over the state. So welcome to today's deep dive. We are jumping into this completely fascinating and honestly slightly terrifying new article to figure out how an entire real estate market basically hit a brick wall. Over the past 5 years, condo dues in a lot of buildings have jumped anywhere from 30% to like over 100%. And that's arriving right alongside these massive, life-altering special assessments.
Yeah, and our mission today for this deep dive is to really unpack the source material and figure out the mechanics of this crisis. Because, this isn't simply a story about inflation.
Right.
And it isn't just about greedy property management companies either. We are looking at this perfect storm. Really, a collision of massive structural decay, a huge regulatory shockwave, and a completely collapsing insurance market. By the end of this discussion, you'll understand how decades of hidden financial decisions created this delayed reaction that is detonating right now.
Absolutely. So whether you are dreaming of a coastal retirement, or maybe you already own a unit on the beach, or you just want to understand how a localized real estate crisis creates these wild economic ripple effects, you really need to hear this. Let's start with the catalyst.
Yeah, the regulatory shockwave.
Exactly. We can't really grasp the financial shock to the system without understanding the laws that started it all.
And that takes us back to a highly specific, very tragic event. The June 2021 collapse of the Champlain Towers South Building in Surfside, Florida.
A horrific event. I mean, it essentially forced the entire state to take a long, hard look in the mirror.
It did.
Yeah.
It fundamentally and permanently changed Florida real estate law. Because, in the wake of Surfside, the state legislature passed Senate Bills 4D and 154, and these bills created incredibly strict safety mandates, targeting any condo building that is 3 stories or higher.
Which, wait, 3 stories. That casts a massive net.
Oh, a huge net.
We aren't just talking about, like, those towering high-rises on Miami Beach. We're talking about almost every standard condo complex built in the state, right? Unless it's some sprawling, single-story retirement community. So what exactly do these new laws actually mandate?
Well, they essentially come down to a strict timeline of mandatory structural reality checks. First, there are the milestone inspections. So if a building reaches 30 years of age, it absolutely must complete a comprehensive structural inspection by a licensed engineer.
Okay, 30 years.
But, and here's the catch, if that building sits within 3 miles of the coastline, that timeline accelerates. Those coastal buildings have to be inspected at just 25 years old, and then every 10 years after that.
Okay, I want to dig into the physics of that for a second, because why the accelerated timeline for the coast? I know salt air is corrosive, but, I mean, we are talking about massive concrete pillars here. How does air actually destroy solid concrete?
Right, it seems counterintuitive. But it's all about a process called concrete spalling. It's basically the silent killer of these coastal buildings. Concrete looks incredibly solid on the outside, but it's actually quite porous.
Like a sponge.
Exactly, like a really dense sponge. Over decades, the coastal salt air and the moisture penetrate those microscopic pores in the concrete until the salt water eventually reaches the internal steel rebar.
Ah, the rebar.
Right, the skeleton that gives the building all its tensile strength.
And when salt water meets steel, you get rust.
You get rust, but
Yeah.
the danger isn't just that the steel gets weaker. When steel rusts or oxidizes, it expands. It can actually expand up to 7 times its original volume.
Wait, 7 times?
Yeah, so you have this metal skeleton inside the concrete suddenly swelling up. And that internal pressure literally blows the concrete apart from the inside out. It cracks, it flakes, and it just falls away.
Yeah.
That's spalling.
Wow. So these engineers are coming in to basically look for invisible swelling inside the pillars.
That and much more, yeah. The milestone inspection is just phase 1. The legislation also mandates something called a structural integrity reserve study. or a SIRS. Associations have to hire specialists to conduct these really comprehensive studies analyzing the remaining useful life of the building's load-bearing walls, the roof, the foundation, fire protection systems, plumbing, everything.
They're forcing these buildings to look under the hood in a way they literally never have before.
Exactly.
But looking at our sources, I have to admit I found something incredibly confusing, and maybe you can clear this up. The legislation mandates that they actually have to fund the reserves to fix these things. Wait, are you telling me that prior to 2021, condo boards didn't legally have to save money for a new roof or foundation repairs?
This is exactly where we get to the financial root of the crisis.
Okay.
For decades, Florida law prioritized self-governance. Condo boards had a legal ability to just hold a meeting, take a vote, and choose to either completely waive or heavily reduce their reserve contributions.
That is wild. But I want to look at this from the perspective of the owners for a second, because I think it's really easy to just call them irresponsible in hindsight.
Sure.
Let's play devil's advocate.
Right.
If you are, say, an 80-year-old living on a fixed Social Security income in one of these buildings, of course you're going to vote to waive the roof reserve.
Right. Absolutely.
I mean, you might not be alive in 20 years when the roof actually fails. Are we really blaming retirees for doing what made rational financial sense for their personal timeline?
No, exactly. Or rather, it was a highly rational micro decision that unfortunately created a catastrophic macro problem.
Right.
If you are on a fixed income, keeping your monthly budget low is your daily survival strategy. Furthermore, low monthly dues keep the property values up, because the units look incredibly attractive to new buyers who just look at that low HOA fee.
It's the classic tragedy of the commons. It makes sense for the individual to defer the cost, but eventually the building itself suffers. It's like, okay, it's like driving a car, right? Knowing the brakes are squeaking.
Yeah.
You and your passengers take a vote, and you actively decide not to save money for new brake pads because you'd rather spend your monthly budget on gas and road trip snacks. You just all agree to keep driving on failing brakes.
That is a great analogy. The car brake analogy works perfectly, but with one crucial caveat.
Okay.
With a car, you eventually crash, or you just sell it to someone else. Here, the current owners are being forced to pay for all the miles driven by previous owners. Because of Senate Bills 4D and 154, the state essentially pulled everyone over simultaneously and said, show us the cash for the brakes right now. We are banning reserve waivers. You can no longer opt out.
Wow. And if they don't have the cash?
Then they have to issue a special assessment to raise it immediately. Which brings us to a huge underlying debate in the source material. Not everyone agrees with how this legislation was rolled out.
I can imagine.
Yeah, property rights advocates and quite a few local politicians argue that the state severely overreached here.
Do they think the deadlines are just too aggressive?
Yes, exactly. The state mandated that these reserves must be fully funded by December 31st, 2024 for many of these key structural components.
Yeah.
Critics are arguing that this zero-tolerance timeline is needlessly bankrupting citizens. They advocate for a phased approach, right? Maybe giving buildings a decade to slowly build up their reserves.
But the state didn't go for that.
No. The
Okay.
state legislature, looking at the rubble of Surfside, basically took the stance that gravity doesn't care about your 10-year financial plan.
That is grim.
Yeah. Safety had to override affordability.
Which means decades of financial can-kicking just hit a legislative brick wall. But, I mean, even if we understand that they have to catch up on 40 years of deferred maintenance all at once, I still struggle with the raw numbers.
The sticker shock.
Yeah. Why are these special assessments jumping to $50 or even $100,000 per unit? I mean, even a completely new roof divided by 50 units shouldn't cost that much, should it?
Well, it wouldn't have a decade ago. But you have to layer in the macroeconomic data from our sources. This regulatory demand shock is hitting the market at the exact worst time in modern economic history for construction.
Oh, the inflation multiplier?
It goes way deeper than just general inflation, honestly.
Yeah.
We're talking about severe supply chain bottlenecks and incredibly localized labor shortages. Just think about the mechanics of what the state just ordered. Thousands of aging condo buildings all need structural integrity reserve studies at the exact same time.
So there's just a massive run on structural engineers.
A historic run. The cost of simply hiring the engineer to do the inspection in the first place has skyrocketed due to basic supply and demand.
Right.
And then once the engineer finishes the report and hands the board a list of mandatory fixes, say concrete restoration and a new roof, the board has to hire contractors. But raw materials like industrial cement, steel, rebar, Commercial roofing membranes and impact-resistant glass, they've all seen massive price spikes over the last 5 years.
It's crazy. You have a regulatory-induced demand shock hitting a highly constrained supply chain.
Precisely. And it doesn't stop at capital projects either. The daily operational costs for these buildings, the vendor contracts for elevator maintenance, 24-hour security personnel, landscaping, pool chlorination, have all steadily risen. So the baseline operating budget is already stretched totally thin, leaving zero wiggle room to absorb the millions of dollars needed for the newly mandated structural fixes.
That paints a pretty grim picture. You have mandated inspections uncovering 40 years of ignored concrete rot, hitting at the exact moment that concrete and labor are at absolute premium pricing, and the state is demanding the bill be paid in cash right now.
Yeah, it's brutal.
But looking at the research, there's another layer here. Even if a building had perfectly funded its reserves and fixed every crack in the concrete, they'd still be facing financial ruin right now.
Yep. Because of the third pillar of this perfect storm, the master property insurance crisis.
Okay, let's break this down because this is huge. This affects every single person living in a Florida condo, regardless of how meticulously they maintain their building. Master property insurance is the policy that covers the exterior building shell and the common areas, correct? Like, not the personal belongings inside the individual units.
Correct. If a hurricane rips the roof off, the master policy pays to replace it.
Yeah.
And the premium rates for these master policies has just surged across the state. Our sources show associations getting hit with rate increases ranging from 100% to over 500% in just a few years.
I'm sorry, a 500% increase in a fixed operating expense? That is unfathomable. How does a volunteer condo board even budget for that?
They don't. They simply pass the cost directly onto the unit owners by doubling or tripling the monthly HOA dues.
I want to understand the mechanism behind that kind of price explosion, though. I know Florida gets hit by hurricanes, obviously, but hurricanes aren't new. Why did the insurance market suddenly break down right now?
To understand that, you really have to look past the local insurance companies and look at the global reinsurance market. Reinsurance is, simply put, insurance for the insurance companies.
Wait, insurance for insurance companies? So when a primary insurance carrier takes on too much risk, they buy a policy to protect themselves from bankruptcy?
Exactly. When Hurricane Ian or Michael causes, $50 billion in localized damage, the regional Florida insurance carriers don't actually have $50 billion sitting in a local bank account. They rely on reinsurance payouts to cover the catastrophic spread.
Ah, okay. It acts like a global shock absorber. You're taking the localized risk of a Florida hurricane and spreading the financial impact across pools of capital all over the world.
That's a great way to visualize it. But that global shock absorber is driven by complex predictive risk models. Reinsurance capital is not a charity, it's an investment. And when global reinsurers look at the data increasing storm severity, rising replacement costs, and highly concentrated coastal development, their risk models start flashing red.
They just decide Florida's too risky.
Or at least too risky at the old prices. So the reinsurers dramatically increase the rates they charge the primary Florida carriers. In some cases, reinsurance costs tripled. The primary carriers, facing massive new costs just to stay in business, immediately pass those hikes down to the condo associations.
And what happens to the carriers that can't afford the new reinsurance rates?
Well, this triggers the vicious cycle we are seeing right now. Many private insurance carriers simply looked at the math, surrendered their licenses, and left the state of Florida entirely. Others went completely insolvent and filed for bankruptcy.
Leaving the condo associations with a shrinking pool of options. I mean, fewer active carriers means zero competition in the market. So if your building's policy is up for renewal, you might only get one single quote, and you just have to take it no matter how astronomical the premium is.
You do, and you can't just choose to go uninsured either. Maintaining master property coverage is a non-negotiable requirement from mortgage lenders.
Right, the banks.
Yeah. If the building loses its insurance, the banks will refuse to issue mortgages for any of the units inside it, effectively freezing the ability to buy or sell anything in the building.
Wow. And there is this brutal irony hidden in this section of our sources regarding how the surviving insurance companies are mitigating their exposure. The premiums are going up, but the coverage is actually getting worse.
Yes, through the manipulation of hurricane deductibles. To keep themselves solvent, the remaining carriers in Florida have significantly raised the deductibles on these master policies.
Meaning if, say, a Category 4 storm hits, The insurance payout won't even kick in until the condo association pays a much, much larger chunk of the repair costs completely out of pocket.
which creates a compounding liquidity crisis for the building. Because the deductible is higher, the condo association must hold significantly more cash in reserve just to cover those potential out-of-pocket expenses during storm season.
Oh my God, that is the ultimate double whammy. By law, under Senate Bills 4D and 154, they must hold fully funded cash reserves for structural maintenance, like the roof and concrete. And simultaneously, because of the collapsing insurance market, they have to hoard separate, massive cash reserves just to cover these inflated storm deductibles.
Exactly. The amount of liquid cash required to simply exist as a condo association in Florida right now is unprecedented. You have to fund the past mistakes, fund the current inflation, and fund the future weather risks, all at exactly the same time.
It's honestly mind-blowing. So if we synthesize everything we've unpacked today, the engineering realities of spalling concrete, at the end of the reserve waivers, the supply chain labor shock, and the reinsurance exodus, what is the single most crucial, actionable takeaway for you, the listener?
I'd say the overarching lesson is that the era of casual condo shopping is permanently over. The monthly HOA fee is no longer a reliable indicator of affordability.
Right. If you are ever looking to buy a condo, whether it's in Florida or honestly anywhere with aging coastal infrastructure, you can no longer just look at the granite countertops and the nice paint color in the lobby. You can't assume a low monthly fee means you found a great deal.
No, in fact, in this current regulatory environment, a suspiciously low HOA fee on a 30-year-old building is a massive red flag.
Yeah.
It almost guarantees they're hiding deferred maintenance.
Because the true cost of that condo isn't the asking price, it's the deferred structural debt. You must demand to see the milestone engineering inspections. You must ask for the structural integrity reserve study. You need to know exactly how much cash the building holds, what their insurance deductibles are, and the exact physical condition of their 1980s concrete.
Absolutely. Due diligence is entirely shifted to the buyer. The state legislation prioritizes safety over affordability, which guarantees that these buildings won't fall down, but it places the massive financial burden squarely on whoever is left holding the deed when the music stops.
Which leaves me with a lingering, bigger picture question. Something for you to ponder long after this deep dive is over. We've established the mechanics behind this, right? The safety mandates are obviously necessary to prevent another collapse. The reinsurance markets are just doing the objective math on predictive risk. The labor shortages and inflation are real macroeconomic forces. But let's go back to that 80-year-old retiree on a fixed income.
Yeah, the human element.
If coastal living now demands this level of massive, immediate liquidity just to stay structurally sound and insured, what happens to the thousands of middle-class seniors currently living in these older buildings?
I mean, if they can't afford the $100,000 assessment, their only option is to sell.
But who buys a condo with a pending six-figure assessment and skyrocketing monthly dues? Traditional buyers with mortgages won't even touch them. Will these buildings undergo a massive wave of distressed sales to cash-rich corporate investors? Will the coast eventually become a fortress exclusively for the ultra-wealthy, simply because they are the only ones who can afford the concrete and the insurance?
It points to a profound demographic and economic shift in the landscape, for sure. The iconic, affordable Florida beach retirement might simply be legislated, engineered, and priced completely out of existence.
It's a heavy thought, but it's the reality of the structural waters we're swimming in right now. Keep your eyes open, demand those reserve studies, and we'll see you on the next deep dive.